What's up everybody, I'm Logan Moody, this is the Contrarian. Today I'll be doing a short video talking about the recent CPI print that just came in much lower than expected. As a result of this, stocks are rallying very significantly. Bonds are also rallying very significantly as treasury yields are falling. Gold and silver are also rallying. Today I'll be talking about how this could be a very pivotal moment for the markets in terms of them resuming a rally after what has been a bear market this entire year in 2022. So before I do that, it's just very interesting to look at the top headlines on Yahoo Finance, as well as seeing how much the major indices are up, how much gold, silver are up, how much bond yields have fallen back to just around 385 basis points on the 10-year. And even just the top headlines right there summarize things very well. How the Fed's maybe thinking about pausing once the federal funds rate hits 4.5%, how CPI report came in significantly lower than expected, stocks are surging off of that, and also this headline pointing out that mortgage rates are above 7% again, and the trouble that that's posing for housing. And in fact, housing is at, in terms of mortgage applications, is at a multi-decade low. So very bad backdrop in terms of recessionary pressures, inflation already being elevated, but the market could be seeing this as a sign of relief that it's finally coming down. The Fed could ultimately see this as a reason to become less hawkish and more dovish, as they will need to be. They will need to step in to support the Treasury market because the Treasury is really suffering right now. Simply with the expenditure that they're having to expend to service the debt at this level. With rates being where they are, you cannot basically maintain the debt at anywhere close to where it is right now. So they need rates to come way down. They obviously first need inflation to come down, and this could prove to be a sort of excuse for them to do so. But basically, U.S. inflation eased slightly last month as the Federal Reserve raised interest rates to get a grip on prices that have surged at a historic pace. The CPI in October reflected a 7.7% increase over last year and a 0.4% increase over the prior month. The BLS said Thursday economics had expected prices rose at an annual 7.9% clip and 0.5% month over month. So it's lower than what was being expected by economists. On a core basis, it also came in lower than expected, with a 6.3% being reported, whereas the expectation was 6.5%. This all goes to show how much people were caught by surprise when this came out. Basically right now there's a lot of short covering going on. How do I know this? Well, put to call ratios were at practically all-time highs, but very historic highs going into this. So people were buying lots of puts, they were hedging for the downside. So put to call ratios is a very good indicator of where the sentiment lies, where the majority thinks the opinion is going. And the majority going into this was very bearish, very cautious, very much wanting to pay historic prices for hedging to the downside. Now, the reason why stocks are rallying is likely the market, the people out there, are realizing that the Fed has very little leeway to go in terms of further tightening. If anything, the Fed could almost be forced to pause pretty soon. In fact, the basic mathematics behind simply where the Fed and the Treasury almost have a different interest at this point could indicate that the Treasury eventually begins dictating what the Fed needs to do. But all of this does point to easing rates in the bond market, therefore less pressure on equity prices. So you could see a significant rally from here, not just talking about today and the short covering that's going on, but you could see a significant rally begin to unfold from here as investors begin to go back into equity markets, major stock markets, major bond markets, as they become less hesitant, less fearful. There is a lot of cash out on the sidelines that people have been just very hesitant to put more of their savings into the stock market. But as they as the market maybe begins to perceive the Fed going back into a pause, or at least a fewer of their rate hikes before pausing, the market could then begin to forecast and price this into the future, saying, okay, in 6 months it's likely that the Fed is already in a pause at that point, so therefore should plan ahead accordingly, should probably prepare for equity prices to rally as a result of that. So the market could in effect begin to almost anticipate this and front run the Fed. Gold and silver also rallying. It's not surprising to see that, even as inflation is coming down, which gold and silver are typically seen as inflationary hedges, but people have avoided them, generally speaking, just because they're not quite certain if the Fed is actually going to seriously fight inflation, or if it's maybe something of a secondary concern. The Fed has to first back up the economy, back up the Treasury before they worry about inflation. So it is very interesting to see that gold and silver are also rallying very significantly right now. They could, in fact, be maybe something that I would more look at in terms of what is the market's perception of what the Fed could be doing. Because if the market believes that the Fed is going to pause, maybe pivot very soon, I would expect gold and silver to continue to rally from here. That's just my thoughts. The bond market could also be a very significant thing to pay attention to. If people realize that inflation could be coming down, the Fed could be nearing the end of their tightening cycle, people could also be getting back into bonds at these decently low bond prices, at these decently high bond yields, simply if they think that the U.S. economy is maybe heading into a recession. I would say that it's already in a recession, but let's say your average investor sees mortgage applications are at multi-decade lows, consumer credit card debt is at all-time highs. They might be thinking, okay, it's likely that we're going into a recession or in a recession, therefore I'm going to allocate more to bonds. So it could also see a very significant bond rally as well from here. All this being said, let me know what you guys think about this down in the comment section below. Have we entered into a pivotal moment for this year, 2022, or is this just a random blip that'll go away very soon? Let me know what you guys think about this down in the comment section below. I hope to see you all again at some point.